Welcome to the week 3 mini lecture. This week we're covering chapters 4 and 5 of our Cornerstones textbook. And this chapter is more about manufacturing direct costs, which means direct labor, direct materials, overhead, and how we come up with costing a product. As a manufacturer, how do we combine all the costs to make something to get a good quality cost per unit that helps us make good decisions about pricing and things like that. So you can see here that this slide has three main columns here. These are the three main costs of manufacturing a product. The direct materials, the things that go into physically making the product. The direct labor is the people who are physically making the product itself. And then you have overhead. Overhead is made up of lots of things. If for a manufacturing company, that would be all of your indirect labor. So that would be some kind of a supervisor, a maintenance person, people who are very needed and very involved in the manufacturing process, but they are not actually physically making the product themselves. That also includes the cost of a factory, a plant. So that would be the utilities on the plant, the depreciation on machinery in the plant, and things like that. And then also indirect material would go into that also. So, if we're making a desk, for example, the main cost of the desk would most likely be, if it's a wooden desk, would be the wood, maybe some varnish, things like that. Well, there also might be some glue and some nails. That might be more of an indirect material. So with anything that's indirect, meaning it's overhead, we have to allocate it based on some method. So direct material and direct labor are directly traceable, but overhead has to be allocated based on some method. So the next slide talks to us about how you do that overhead allocation. And we do it based on what they call the predetermined rate. And so what companies do is they look at the future, before a year starts, and they make estimates. They estimate for, here is how much overhead we'll have for the year, and here is how much of whatever the activity driver will be to deal with that overhead. So, and that might be direct labor hours, direct labor cost, machine hours, just whatever we can use to allocate the overhead. There's really no right or wrong item to use as that driver. It's just whatever makes sense for that company or that product. But we use the predetermined rate to allocate overhead. And because we're using a predetermined rate, at the end of an accounting period, we'll have either over-applied or under-applied overhead. So just want to make sure you're reading that and know what those terms are. You will have questions on some of your work this week where you have to know what the difference between those two is. So just want you to be aware. And then we also want to talk about the fact that this concept works not just for manufacturing, but also works for service companies. Okay, so just imagine that we can still allocate costs and we can still come up with what is the cost of providing a service. So imagine if you're an accounting firm and you are doing taxes and audits and all the different services that an accounting firm does. You have to know what your cost of providing that service is so you can bill accordingly and of course make a profit. So service companies also need to be very aware of what their cost of making something is. So this is kind of an old example, but they use an internet cafe as the example. This comes right, an example from your textbook. A beauty salon is both a service, and beauty salons obviously also sell products if you would like to buy one there. Most will sell something. A restaurant is a service, but they're selling you a product that you typically consume on the spot or maybe take home. Software is also a service, but you use software with your computer, and then obviously a manufactured product. A couple of examples are automobiles and cereals. But just keep in mind that these concepts we're learning in week 3 here really do pertain to both services and manufactured goods. So this just gives us an example of how we accumulate costs and then we allocate them to various products. Most companies are making a variety of products or providing a variety of services. So direct materials are the things that go into directly making their product, and we directly trace those. Same thing with the labor for the people who are assembling or finishing our product. That's direct labor, the people who, their job all they're doing is making the product or finishing the product. We know their time belongs specifically to a product. And then we have overhead, which is everything else. So supervisors, depreciation on my factory, depreciation on machinery, utilities on my factory, property tax on my factory, landscaping on my factory, just any cost that pertains to my factory in general, I'm allocating. So direct material and direct labor, I directly trace. Overhead, I allocate. And so we have to accumulate costs throughout an accounting period. So typically jobs are numbered. And it says here in this particular example, we have job 16 for a company called Benson Company. We're making valves for them, 100 valves. And so we have to keep track then of what the direct materials are. We requisition materials to make these valves. We keep track of direct labor, how many hours were spent, what was the rate of labor for the people working on that particular job, and then we allocate overhead. And so a job order cost sheet accumulates the three costs, the direct material, direct labor, overhead, then divides the total cost by the units to get a cost per unit, which is obviously needed to make sure we're pricing correctly. So a materials requisition form is just a form that a company uses to requisition raw materials to be used for a specific product. As an example of one. Same thing with a time ticket. Obviously, if Ann is a direct laborer, her employee number is 45. Ann's going to keep track of the time spent on particular jobs, right? And then somebody in payroll will track her hourly rate and assign her time to those jobs. And so a completed job order cost sheet then has all those costs all together summarized. This is a different one for street signs, and it accumulates the three main costs. Divide those costs by the quantity of good made, and then we get a cost per unit. And so that leads to what they call the statement of cost of goods manufactured. So this is what companies put together to help them figure out what was the cost of making our goods for the accounting period. This one happens to be for a month. So you're keeping track of how much direct material was used, how much direct labor was used, how much overhead was allocated, and then you have what's left over is your cost of goods manufactured, 1,840. So we'll be looking at this closer this week. Obviously, you'll want to read about this in your chapter also. This is coming from both chapters 4 and 5 this week. So just make sure you're aware of the statement of cost of goods manufactured. Then once that is done, then we can make the statement of cost of goods sold. Remember that manufacturers are making a product that they then sell to their customers. And cost of goods sold represents the cost of the goods manufactured and then sold to our customers. And the last one is the income statement. All companies make income statements, even service companies too. So it's your sales revenue minus your cost of goods sold equals gross margin, also called gross profit. Then you subtract your operating expenses, selling expenses, administrative expenses, you get down to your operating income or your net income. But that's a common income statement. I would guess most of you have seen an income statement at some point in time in your career so far. But you will be doing a little bit of homework this week dealing with these financial statements and coming up with the cost of a particular product. So I just want to make sure you're aware of those. And reading chapters 4 and 5 would be obviously very important on top of that.